What happens when oil prices suddenly jump and gold starts falling at the same time? That is exactly what caught the market's attention. A sharp rise in oil prices created fresh concern across the financial world, while gold, which is usually seen as a safer asset during uncertain moments, moved lower instead of higher. At first, that may sound strange. After all, gold often attracts investors when global tensions rise. But this time, the market was focused on something else: inflation. The big trigger was the sudden surge in oil prices, linked to growing tensions in the Middle East. Investors became worried that the conflict could affect energy supply routes or key infrastructure, and that fear pushed oil higher. When oil rises quickly, the impact goes far beyond gas stations. It can increase transportation costs, raise production expenses, and make everyday goods and services more expensive for consumers. And that is where the pressure on gold began to build. As oil climbed, investors started to believe that inflation could remain stronger for longer. That also meant central banks, especially the U.S. Federal Reserve, might decide to keep interest rates higher for more time, instead of cutting them soon. That matters because gold does not pay interest. So when rates stay high, many investors look for other assets that can offer returns. In this case, concerns about inflation and interest rates became stronger than gold's usual safe haven appeal. And as a result, gold prices moved lower. The stronger U.S. dollar also added more pressure. Since gold is priced in dollars, a stronger dollar can make gold more expensive for buyers using other currencies. That can reduce demand and put even more downward pressure on the metal. What this shows is how connected the global economy really is. A geopolitical conflict can push oil prices higher. Higher oil can increase inflation fears. Inflation fears can change expectations for interest rates, and those expectations can then affect gold, stocks, currencies, and the broader market. For everyday people, the effects can be easier to understand than they seem. If oil remains expensive, fuel prices can stay high. Businesses may then face higher transportation and operating costs, and those costs can eventually reach consumers through more expensive products and services. At the same time, if interest rates remain elevated, borrowing money can continue to be more expensive, affecting loans, credit cards, and mortgages. So the main takeaway is clear. Gold fell not because uncertainty disappeared, but because the market became more focused on inflation and interest rates than on gold's traditional role as a safe haven. The rise in oil changed the mood of the market, and investors reacted quickly. If you enjoy clear and simple explanations like this, subscribe to the YouTube channel so you do not miss the next videos.